A consultant based in Texas does 3 weeks of on-site work in New York. Texas has no income tax. She files nothing in New York. 2 years later, New York's Department of Taxation sends her a bill for $11,400 plus penalties and interest because she established what's called a tax nexus in New York the moment she performed services there. She had no idea. Most self-employed people don't. Working across state lines doesn't just mean more clients, it means more tax jurisdictions, and those jurisdictions are actively looking for you. Nexus is the legal threshold that determines whether a state has the right to tax your income or business activity. For self-employed individuals, nexus is typically established by physical presence, meaning you personally performed services in that state, even temporarily. Some states go further. New York's convenience of the employer rule taxes remote workers whose employer is based in New York, regardless of where the worker actually sits. 14 states currently have similar provisions. Your state of residence is not the only state that has a claim on your income. The threshold for filing varies by state. California requires a non-resident to file if they earn more than $1 of California source income. There is no de minimis exception. New York's threshold is $0 of New York source income for non-residents. Other states use day count thresholds. Arizona triggers filing after working there for more than 60 days. Minnesota after 183 days. If you travel to perform services, installations, consulting engagements, speaking, training, you need to know the rules of each state you physically enter to work. Apportionment is how states divide your total income to determine what they can tax. Most states use a 3-factor formula: sales, payroll, and property. For a solo service provider with no employees or property in a state, only the sales factor typically applies. If you earned $200,000 total, and $40,000 came from California clients, California can claim 20% of your income as California's source income. That $40,000 gets taxed at California's top rate, which for self-employed individuals can reach 13.3%, plus California's SDI tax. Most states offer a credit for taxes paid to other states on the same income, which is how you avoid true double taxation. But the credit doesn't eliminate all additional cost. If your home state has a 5% rate, and you work in a state with a 9% rate, you pay the 9% in the high-tax state and receive a 5% credit at home, netting a 4% additional burden. The math matters before you take the engagement. Know the blended rate, not just the client's budget. Remote work created a separate and still evolving problem. If you're a self-employed consultant working from your home in Colorado for a client headquartered in Illinois, who does Illinois think earned that income? Depends on the nature of the work. If the benefit of the service is received in Illinois, a contract, a software implementation, a report, Illinois may assert the right to tax it. The market-based sourcing rule now applies in more than 30 states. Your physical location matters less than where the client uses the work. Your first strategic step is to track every dollar by state of source, not just client name. When you invoice, note whether the work was performed physically in a state or delivered to a client in a state. This distinction matters for apportionment. Build this into your bookkeeping from day one. Retroactively reconstructing which $40,000 came from where after an audit notice arrives is an expensive and time-consuming exercise. Your accounting software should have income categories by state. Set it up before tax season, not during it. If you've been working across state lines without filing and haven't been caught yet, most states offer voluntary disclosure programs. You come forward, file returns for prior years up to a capped look-back period, typically 3 to 4 years, and penalties are often waived or substantially reduced. California's Voluntary Compliance Initiative and similar programs exist in New York, Illinois, and most other high-income states. It is categorically better to approach the state voluntarily than to wait for the assessment letter. At that point, you lose the negotiating position. For ongoing operations, a CPI who specializes in multi-state taxation is a genuine investment, not a cost. The filing fee for a non-resident return is real, but so is the risk of accumulating 3 years of unfiled liabilities. If you work in 5 states and pay a CPI $800 per additional state return, that $4,000 is fully deductible. Compare it to a $12,000 assessment with penalties. The math is straightforward. Multi-state exposure is one of the areas where professional preparation pays for itself the most clearly. Multi-state tax exposure is the tax problem that compounds silently. 1 year of unfiled non-resident returns becomes 3, and then you're facing a 4-year look-back with interest. Track income by state from day 1. Know the nexus thresholds. Use voluntary disclosure if you're already behind. For self-employed people who work remotely, the video on the digital nomad tax problem covers what happens when you take that same concept across international borders. Crossing state lines creates tax claims you never expected. Crossing international borders creates a different set entirely. The digital nomad tax problem covers what you actually owe when the work follows you abroad. It is on this channel.